Okay, so this is the first episode of Rico's Report with my friend Aris with
The Mortgage Phoenix Group.
the Mortgage Phoenix Group.
Yeah. It's kind of a mouthful.
This is an impromptu recording. This is the first recording, and hopefully it goes well. And we're going to make it just the best of it.
Yeah.
Okay?
Yeah, it's kind of an impromptu, just kind of walked in your garage today, and I really enjoyed because I think you did a really phenomenal job with it. And first thing I saw was just live with passion, and I know that you embody that, and you want to make your life count, which is just great.
Live with passion.
That's right.
We have to live with passion. So, Aris, tell us about you. You're a mortgage advisor.
Mm-hmm.
How long have you been in the business?
Yeah, so I'm a mortgage planner with the Mortgage Phoenix Group in Rancho Cucamonga, and I haven't been with very many companies. I had a calling to come to the Mortgage Phoenix Group, which is part of a larger bank, American Pacific Mortgage. In the industry, we're considered a direct lender, which means that we fund our own loans. We do everything in-house, and we just cater to just mortgages, whether it be you're a first-time home buyer, or you're looking for down payment assistance, or you're looking to basically build your real estate portfolio, or you're looking to buy your second home. We cater to that. So I've been in the industry for quite a long time, 21 years, since 2001,
You mentioned mortgage planner.
Yes.
After I said mortgage advisor.
Right.
What's the difference?
Well, I think that, advisor is sort of like someone that, kind of guides you through the whole process and looks at your finances and make sure that they're structuring the right loan for you, right? A planner, I think, is embodying financial principles or teaching you financial principles and want to stay with you for as long as you have your home, as long as you basically want to invest in real estate. So it's more of structuring the same loan or the type of loan that fits your needs or meets your needs, but also, being able to do it with overall process of teaching financial principles to our clients. So rather than just saying, hey, here's what you qualify for, here are the terms, go out and shop, and then you figure out like, wait a minute, did we touch all the subjects? Did we touch all the options available in the marketplace? Am I eligible for down payment assistance? I'm a first-time home buyer. Like, should we talk about that? So it's more a thorough process of making sure that we stay, with you through the whole process of you owning a home and maybe wanting to expand in your portfolio.
Okay. You mentioned a first-time buyer. What is a first-time buyer?
Yeah.
Besides, obviously a first-time home buyer is a first-time home buyer.
Yeah.
But what exactly does that mean in mortgage?
In mortgage, what that means is that if you haven't owned a home in the last 3 years, or you haven't been on somebody's title for 3 years, like you could have had a home 3 years ago, right? But now you don't own one, you are considered a first-time home buyer. And simply what that means is that you're eligible for low down payment programs, like FHA, 3.5% down payment, even some down payment assistance programs, or first-time home buyer. It simply just means that I can buy a home with a little out of pocket as possible and be able to basically get into a property. Okay,
so you said a first-time home buyer is a person that has never owned a home in the last 3 years.
3 years.
But they've never been on title.
Yes.
So can a person be labeled as a first-time home buyer if he's a co-signer in a property, not the primary, but he's a co-signer, and he's less than 2 years on that? Is he considered a first-time home buyer?
Yeah. Unfortunately, no. They're not considered a first-time home buyer because they already own, even though maybe they co-signed and, the agreement is for them not to have ownership of the home or right to the property. In our eyes or our point of view, you are a homeowner already, whether you're not partaking in equity position or you're not, fully vested in, getting something back from the home, you're still considered basically not a first-time home buyer.
So if you're on title, it doesn't matter.
It doesn't matter. No, you have title means ownership.
Okay.
So if you have title ownership,
so you have to be on title.
Yes, or loan.
Or
loan, right?
What happens if they're not on title, they're not on the loan, but they're in a trust as a beneficiary on that property? Are they considered first-time home buyers? Or
Yeah, they are. I mean, I think that, a lot of us have been conditioned, especially if we have elder parents or family members that, they want to protect themselves. They want to protect the interests of their home, and maybe they want to add somebody on title just for protection. I know a lot of Latino families, a lot of my Latino clients, Hispanic clients tend to do that. And that's not the right way to go about that, because when you add somebody to title, you're basically giving them ownership of the home. So they get to decide on the home, and maybe the interest was just to protect, right? In case something happened to the family member, the mom and dad,
right?
The kids can make decisions basically on that. But in the financial principles that we teach, protection, asset protection is one of them, which is basically creating the living trust, right? So a living trust doesn't give you rights to a home. It simply basically positions you that if something were to happen to, to the owners of the home, like mom and dad, for instance, right? That if you were a beneficiary of that home, then it's laid out in the body of the living trust that if something were to happen, automatically the home goes to my beneficiaries. And if you were one of them, well, that home will go to you, right? So being in a living trust doesn't give you right to a property.
Okay. So let's just say hypothetically they're on a living trust. They're not on title.
Yeah.
They're not on loan. They're in the living trust. Everybody passed away. But it has to go into probate.
Yes.
Can that person still buy a house while that house is on probate? Is that person considered a first-time home buyer?
Yeah, they would be considered a first-time home buyer. A living trust is a legal document. It's a recorded document. It just basically simply is to avoid probate, right? You don't necessarily have ownership of a home. If the owners of that property or the owners of the living trust, if they passed and you were a beneficiary, that's when you will get access to the home. You obviously have a trust deed, like, for instance, if I created one, I can have my brother, the trustee, to look over my assets in whatever direction I gave him. Then he's able to basically kind of complete the process of liquidating what's in my estate, right? It creates that instant estate.
So is a trustee the same as a power of attorney?
Very similar. A trustee is somebody that just kind of executes the desires of the owners, right? So it could be an attorney, it can be a close friend, it can be a family member, right? It simply just says, okay, well, if I pass, I want my son to get 25%, my daughter to get 25%, or I want my church to get 50%, and I want my son to get 50%. So you give direction to your assets, whether they're real estate or, personal assets, right? Cars, retirement accounts, things of value.
Got it. Okay. And so that takes care of all those questions. And what benefits does a first-time home buyer have? Because everybody hears about, money, down payment assistance.
Yeah.
Many people confuse that as grant money, that it's free, that you don't have to pay it back. But we all know that nothing is for free.
Right.
So what exactly is down payment assistance?
Yeah. So down payment assistance is simply a way of you not having to come with all of the money for down payment and closing costs. See, when you buy a home, you have your investment, which is your down payment.
Right.
And then you also have the cost of arranging the financing, such as the lender, which is us, notary, appraiser, escrow, title, recording fees, all the parties associated in doing a transaction, right? And that is dependent on the purchase price and how much is that and how much escrow companies are charging, basically. So think about your down payment as your investment, right?
Right.
So in a normal scenario, if you're buying a home, you need to come in with your own down payment, which is your investment, right?
Right.
And the closing costs. Well, essentially, down payment assistance is where the state of California, or in this case, probably the most popular program is CalHFA, California Housing Finance Authority, right? So CalHFA is basically a government-backed entity, right, that allows first-time home buyers. Again, the classification was having owned a home in the last 3 years, can be part of a title, right, as somebody that, owns property. That classifies you for them, a first-time home buyer, right? And so essentially what they're saying is, look, we know how difficult it could be to put a down payment together and put all this closing costs, right? Maybe the traditional purchase could run anywhere from $28,000 to $35,000, right, to buy a house. Well, they're covering the down payment, so they're giving you assistance to put that money down, right? They're giving you that assistance, meaning that they're going to cover the down payment and you just basically cover the closing cost, right? So that tends to cut things in half for you.
So a down payment is not a grant.
It's not a grant. No, it's with that program, you have to pay the money back.
When?
When you either sell or you refinance the house.
Is there interest on the down payment assistance?
There is, but it's very minimal. It's 1% on the money loan. So let's say I buy a house for, $500,000 and my down payment assistance was $17,000, right? So I get that $17,000 in assistance. They're charging 1% a year, which is $170 a year. So if I stay on that loan for, X amount of, maybe 5 years, let's say, right? Mm-hmm. I just got to pay them $17,000 back plus $170 per year of interest, right? So that's probably
Which is a small price to pay.
Yeah, it's a small price to pay because in comparison to you having to save up the down payment,
right,
plus the closing costs, let's say you have to save up $30,000. The average family, how long does it take for them to save $30,000?
A lot of years.
5-7 years.
Yeah.
So if you can cut that in half and get into homeownership right away, right? That's a benefit to you to do that.
Who qualifies and what are the requirements for the for the down payment assistance? Does the person need to have a certain income cap?
Yeah.
FICO score? This is a 3-part question.
Yeah.
And the third one is, can a person with an ITIN number qualify for a down payment assistance?
Yeah, very good question. So you got to meet the loan requirements and, income limitations is one of them, right? And I'll give you an example. Riverside, San Bernardino County, you can make about $173,000 or less. $173,000 or less.
A person?
A person or a family.
That's not low. That person does not need down payment assistance.
Well, trust me, they do. Sometimes, people make a lot of money, but it's not how much you make, it's how much you keep, right?
So it has nothing to do with the income.
It does. If you don't earn more than 173, you're eligible for that program. So what is the average family here in San Bernardino?
How do they calculate that money?
Just gross receipts or gross income, W-2s, pay stubs, income calculations. So
so it has to be a W-2. What about a business owner?
A business owner too. So if you file income taxes and you have your taxes in orders and we look at your net income, we look at the last 2 years of taxes.
If he gets W-2s, then he's an employee of his own business.
Yeah. So if you're incorporated, let's say you have a S Corp and you're paying yourself and you're giving yourself a W-2 and it's documented and we can basically document how much you're earning. Yeah, we can use that income structure. But simply it just states this. If you earn $173,000 or less income in San Bernardino or Riverside County, you're eligible for that program. That's one requirement, right? There's also a credit requirement. So if you have a minimum, you have to have a minimum 640 credit score, right? Down payment assistance are very conservative loans. They're not going to stretch your ratios. They're not going to put you out too much. They want to make sure that you can qualify for that home today and you can stay in home ownership, right, for the span of time that you're in home ownership, right?
Okay.
When you put your own money down, it's like you're kind of betting on yourself, right? You can stretch a little further out because the bank is not loaning you more than what they should. When you're getting down payment assistance, it's like you're borrowing 100% of the value of the house.
I'm still stuck in $173,000. Okay. Is that... So what happens if... So basically the person that makes that much money, very good money.
Yeah.
And they qualify for down payment assistance. What about if that person is married and both of them combined surpass the 173? So how does that work? Does the person has to be, it sounds like the person has to be single.
No, not necessarily, because you have married couples and let's say the husband or wife are.
But if the minimum requirement, sorry to interrupt you, it's 173,000 a year. If both of them combined, let's just say that's 250,000. So they don't qualify.
Yeah, you're right. So you can make up to 173,000. So you can make less, right?
Right.
So $173,000 or less. But if you have a family, right, that is earning more than 173, kind of going back to your point, like if you're making 173, why can't you afford to bring your own down payment? But you'd be surprised, man.
Spending too much time at the Louis Vuitton store.
Money comes, money goes.
Okay.
It's a vicious cycle, I think, because people's perspective is that money is always going to flow,
Right.
and it should. But money only flows in a way that it's there when you need it, and if you can't do something positive with it, right? Because money is energy. For me, money is energy.
Right.
So if I'm focused on buying a house and I'm making that kind of, income,
Yes.
and I'm focused on buying a house rather than living a lifestyle that, maybe I'm driving a nice car, I'm dressing myself really nice, I'm taking 2 or 3 vacations a year, right? But my focus is buy a house, and I'm spending all these areas, and my money is leaking to all these areas, but my focus is to buy a house, and I don't have a penny saved, then the focus is not to buy a house.
So it sounds, if I'm understanding correctly, the 173 a year has nothing to do with the individual. It pretty much has to do with the application, right?
Correct.
So
Correct.
if you have as many buyers as you can get under one application, say the mom, the dad, and the son,
Right.
or doesn't matter. So it's no more than $73,000
173
thousand per application.
per application.
So the
Correct.
application could have as many as 5.
Yeah, you can have up to 4 applicants in an application.
Oh, so there is a limit.
Yeah, there's a maximum, right?
Maximum.
So 4. No more than 4 applicants per application.
Are
So
those applicants need to be related, or can it be?
that's a very good question, and yes and no. You can have combined families, right? Like extended family, like my cousin or my uncle, or
Does it have to be
something like that.
family? What about a friend?
Yeah, friends is a touchy subject, because as long as we can create a history that they've been living together and they're moving in together, maybe there's 2 families coming together and they're going to reside in the same home, then we can do that, right?
So they have to live in this home.
Yes, sir. Yeah, it's owner occupied.
Got it.
So yeah, so it's owner occupied, right?
Right.
640 credit score requirements, up to 173 income or less, right? If you make more than that, you're not eligible for the program. Like you mentioned earlier, if you have a family that earns more than $200,000, well.
So let's just say
Yeah.
they meet the requirements, right? But that's their base. But they surpass that in bonuses, in Christmas bonus, extra commissions. Do you guys use that against the 173, or just 173 is?
Well, if they have a history of earning bonuses or getting bonuses, and we verify income and it's in the income breakdown, we have to take what's actually reported, right? So we calculate overtime, bonuses, base income, all the calculations
But
that
commissions and overtime is not always.
Correct. So it's an average. So if somebody is making commission on sales, for instance, right? Commissions vary depending on productivity,
Right.
Market, right? And how well somebody does, right? And how desirable the product is. And so that's why it's average. So it's average for 24 months. It's average for, the 18 months, right? So, and even year to date, like for instance, in real estate, there's fewer sales now, right? So people's commissions are less.
Right.
So if you're projecting that your commission is less than what it was last year, then your income is declining, right? The underwriter most likely will say, well, you have a declining income. I can't really give you 2022's income.
Right.
When you earned a lot, and year to date, you're not showing that.
Right.
If it's commission based. But if I'm a fixed salary, right? And let's say my hourly wage is $50 an hour, and if I work 40 hours, well, that's more of a easier calculation, right? Because it's predictable. We know that if you work this amount of hours and you're earning this much, this is what your gross income should be. And that's more easier to manage for us.
So no more than 173,000 a year, up to 4 applicants per application.
Right.
They have to live there.
They have to reside in the home.
They have to reside in the home.
They have to meet a credit requirement, which is minimum 640.
Credit requirement.
And you also have to take a home buyer's education course.
Home buyers. How long is that?
It's 8 hours online, and it costs $100.
Okay. Is it 8 hours on? Can it be broken down in 4 hours?
Yep. You can take them at your leisure, at your pace. If
So
you want to
do an hour a day for 8
an hour a day, 2 hours a day, whatever you want to do.
Is there a test at the end?
Yes. There will not necessarily a test. It's more of a consultation.
Got it.
It's more like
Like
well,
an open book test.
yeah, like, hey, let's look at your application if you were to buy a home, right? How much of your income are you using? Because this program allows a certain amount of income to debt ratio, right?
Yeah.
Credit requirements, home ownership requirements, that kind of thing. Think about, just having kind of an education course that guides you through that process of how to be a homeowner, what is credit, how to basically manage a home, right? What is the income? What is your income against your housing expense, your liability expense, and having like just that broken down for you.
Okay.
Rather than you just kind of figuring it out on your own, right? Because for me, sometimes what I tell my clients in homeownership is like, look, no one was really made to be a homeowner, right? It's like there was a greater need than just being a renter. So, like,
well, it's easier to get into a house when you rent.
Well, at this stage, like, you're looking at 2 to 3 months worth of, 2 months of deposits, first month's rent. The average rent is $3,000. That's about $10,000, right? So when you look at it, if the qualifications of renting a house are similar to buying a house and you have a little bit of savings saved up, I say buy a house.
That was going to be my next question. I know there's a lot of programs out there, and there's so many to keep up with. But I do know that there's a lot of programs that do help you.
Yeah.
They're there. But there's a lot of stipulations. You're not supposed to have a certain amount of money in your bank account. Is that what the down payment assistance, do they don't have no more than 30,000 in savings or 25 or
right?
Have you heard of that? Because I have.
Yeah. There's not a limitation on how much you should have in the bank when you go buy a house.
Because if you're making 173 and it's a family, and they've been renting, because in our culture, very well, that we could become very conservative where, in 2 years we could easily come up with $150,000 down in savings combined with those 4. Best case scenario. Okay. So down payment assistance, do they look at your bank statements and you're like, wait a minute, you have $150,000 in savings.
Yeah.
Why do you need this money?
It's not really looked upon like that. Simply because, people that are using down payment assistance, it's sort of like you're leveraging the program, right? It's like I have the money.
Taking advantage of the program.
I don't know if you're taking advantage when it's there.
That's what the word leverage is.
Right. And leverages means, hey, I'm good for the money, but if I can borrow it and qualify for it and, not use my money, then...
Isn't that like taking away from the person that needs it?
Not necessarily.
If I was a loan advisor or loan planner, I would be like, wait a minute. Why are you here?
I hear you. So let me paint this for you, right? So most people, when they think about down payment and think about buying a house, their main focus is how much money can I get? How much of my own money can I use to get into a house, right? Without depleting everything, right? Right?
Because we don't.
Nobody wants to basically use all their funds and be like left with nothing, right?
No, I mean, big companies do that. I mean,
right.
I heard the other day that Apple has like over $1 trillion in cash and they still borrow money.
Correct.
So I get it, but obviously that's a public traded company where individuals, there's different rules.
Yes.
So is that used against them?
No, it's not used against them. It's not you can't really discriminate on I'm too wealthy to basically try to put my own down payment, right? It's more like I'm too savvy. I'm too, right? So by all means, if you have, let's say, $50,000 in the bank and you're eligible for a first-time home buyer program or down payment assistance, you got to remember that with first-time home buyer programs, if I am debt heavy, or I'm paying too many debts on credit, right? Then I may not be eligible for that program because it's more of a conservative program. It's really for a program that I have very little debt. My monthly payments are very small, right? I'm not carrying a lot of I'm not putting down a lot of monthly payments, right?
What is heavy debt? Because in my perspective, I see, okay, I owe a lot of money.
Yeah.
But my monthly payment is very minimal.
Mm-hmm.
So when you say heavy debt,
yeah,
are you looking at the balance or the monthly payment?
Monthly payments. We're looking at monthly payments. We're looking at somebody that maybe have a car payment, credit card payments, perhaps have student loans that are in deferment or forbearance. They're not currently paying on those student loans. And, for qualifying purposes, we have to assume a monthly payment. We have to know that at one point those payments are going to come due. And the government is going to ask for their money back, right? If they're not, wiping that debt for you, which we hear that a lot of government programs that, are giving, people with, with those type of loans an incentive to not pay them back, which I don't know if that's right or wrong, but,
it's our perspective.
Right. So it's like, okay, if you borrow, you got to pay back, right? In a sense, right? To me, right? That's simply me. But for qualifying purposes, we have to account a minimum monthly payment for those loans. So if you have a $10,000, let's say, student loan, 1% of that's, $100, right? I'm sorry, it's $10.
Mm-hmm.
If you have, $50,000, it's like $500, right? So we have to.
I think it's more than that.
Yeah. It's 1%, so it'd be about $500 a month,
Okay.
So just for qualifying purposes. Now, you may be okay not paying a payment. You may be in deferment or forbearance, and that's cool. You're not making payments, and you're probably praying that they get wiped out, right?
Yeah,
but they don't. It's people want their money back. You borrow it, and you have to pay it back. So the whole idea with down payment and with loans is really simple. It's just taking a look at your income to debt ratio, right?
Okay.
And so when you want to buy a house, what the lender does is assesses your monthly payments on credit, right? Car, student loans, credit cards, 401k loans, installment loans like a furniture or something like that. Takes that, right? It takes your gross monthly income, right?
Right.
And you cannot exceed a specific amount, like 50% of your gross income. So I'll give you an example. So if I make $10,000 a month, right? $120,000 a year. Simple math is just cut that in half, right? That's $5,000. And let's say my overall output is $1,000 a month in cars, credit cards, student loans, and stuff like that, right?
Right.
So if I do the math, 5,000 minus $1,000, I'm left for $4,000.
Right.
So $4,000 is my budget for the amount of mortgage that I can have. Not that I should have, but I can extend to. I can basically.
Is that how you guys calculate it?
That's it. Really simple.
It sounds simple, but it could be complicated to a lot of people.
Sure.
That's why you guys call yourself financial planners.
Well, yeah.
Oh, mortgage planners.
Mortgage planners.
Okay.
Yeah, it's really simple in that way. And maybe for the consumer, it's not that simple because they're thinking, man, but $4,000. Yeah, that may be what the income allows me to afford, but my affordability is $2,500, right? And then my question is that within line of what mortgages are today?
No.
Right. Is that within line with what rents are today?
No.
Okay. So if you're going to rent and your rent is, let's say, $3,000 and your mortgage is $3,800, by the time you weigh those together, right?
Right.
The benefits of owning, the tax write-off, the home appreciation, the balance depreciation, right, every year with making, or every month with making your monthly payment. By the time you dissect that and you analyze all that, that person that will be renting a 3 instead of buying a 38 should be buying, especially if they're going to stay there 2-3 years in a home, with the amount of appreciation that is projected in the next 4 to 5 years. They could be making 20%, 25% in a home.
Okay. So, can a person with an ITIN number qualify to get a down payment assistance?
Yeah. So you got to think of loans a couple of ways, just two ways, right? So you have the conforming conventional loans where you have to basically meet this box requirements, right?
Yes.
Those are government-backed loans,
Right.
right? Through FHA, Federal Housing Finance Authority, right? Or Federal Housing Agency. And then Fannie Mae, Freddie Mac loans. And if I'm a veteran, well, VA loans, right?
Right.
So those are the government-backed. So that means that if I have a Social Security, I'm a legal resident, or I have, citizenship, I'm backed by those loans if I qualify, right?
Right.
So you have those conforming loans, right, that you got to meet the box, right? And then you have alternative loans or outside of the government agency loans, right, which are more maybe credit union, hedge fund, private money loans, private investor loan, right? Private money, right?
Which the interest rate are higher.
Higher.
How much higher? A whole point? Half a point?
Yeah. So let's say the going rate is 6.5, right?
Right.
Those loans tend to be about 2 points higher.
Whoa.
Yeah. Because you got to remember, like, if you meet the requirements of the government-backed loans with credit, income, debt-to-income ratio, legal documentation, right?
It's a government program.
Right. It's a government-backed program.
A government-backed program.
Yes.
But isn't an ITIN number a government-backed program?
No, it's not. Because an ITIN is just...
Who gives out the ITIN number? The government.
IRS. IRS
Which is
gives
the
it.
government.
No.
We already know it's not. It's a bookkeeper. It's not the government.
Yeah, it's the bookkeeper for the government.
Yes, no, I get that. But many people think that the IRS is the government. That's why I said
It's an entity of the government.
So ITIN number is given by the IRS.
Yes.
Okay.
For
I did not know that.
Yeah, for income reporting.
Got it.
Because even though you're working with an ITIN, right, the IRS still wants their portion of their income tax.
Okay. So a person with an ITIN number does not qualify for a down payment assistance.
They don't. No, they don't.
Can that person with an ITIN number be part of one of the four of getting the down? So let's just say mom and dad and the son. They're all legal, they're all here, they're making good money. But one of the kids has an ITIN number.
Right.
Can that fourth person be part of the down payment assistance for qualification purposes?
Yeah, that's a very good question. So no, the answer is no.
No.
Because when it comes to financing, all applicants need to have legal presence here. All applicants need to have a minimum credit score requirement. And all occupants need to basically, or applicants need to basically qualify for all the terms, right?
So a person with an ITIN number doesn't have a FICO score?
They do. They can build credit with... Here's the interesting part. You can build credit with an ITIN. Most ITIN persons don't know that. But when you have established a history with your bank, right? And you've been there, let's say, 3 to 5 years. Some of them will start giving you credit cards or extending you credit.
Well, secured.
Yeah, secure. Well, secure and unsecure, because they're basing it more on your standings, right? Your history.
Got it.
Your relationship with the bank, right? And so think about an ITIN. Think about if everybody's documented, but one is ITIN, that loan automatically defaults to an ITIN loan.
The whole thing.
The whole thing. Or that applicant should be included.
So that would only benefit a family that wants that person on title. Right?
Yeah.
Let's just say, now hypothetically,
Yeah.
the mom and the dad are ill, and the only way they can leave, if they don't know anything about trust, if they don't know anything about that, I think that's the type of people that would put that child with an I-10. They'll pay the extra 2 points in the event that they pass away. That child keeps the property.
Yeah. So we're talking about, them being able to qualify for a loan, right, with an I-10, right? So if that individual with an I-10 is not necessary to qualify for the loan, and let's say in that scenario you had 4 people, right? 3 are documented, 1 is I-10, and the one with I-10 is not needed to qualify, then we can just do it with those 3 individuals, right?
Right.
There is ITIN loans. It's just that they're more difficult. There's more qualifications, right? I've been part of some ITIN loans or some borrowers or doing financing for ITIN, but man, they throw the book at you, right?
Right.
You gotta meet all these requirements. You gotta be perfect. You gotta dot your I's, cross your T's, and
Right.
you have to have all this stuff that is needed, right? Since they can get a loan and they can have possession, they can have title to a home. You can title somebody that has an ITIN, because when you give somebody when you ask somebody to title, the grantee is not asking you for a social security.
No.
No, it's not. The social security is only needed at the time of sale for tax purposes, right? So escrow will require a tax ID number, which could be an ITIN or it can be a social security. So if I sold a home and I have to pay capital gains on the sale, well, guess what? You can pay them through your ITIN, because ITIN is just to report income, whether it be wages, capital gains, self-employment tax, all those things.
So, you mentioned self-employed.
Yes.
If a person has an ITIN, but he has a self-employed,
Okay.
do they still qualify for a loan and still pay the extra 2 points? Or can they, what's the best scenario for that person with an ITIN and a business? Obviously they don't have a restaurant, but they have, handyman service, paint, landscaping.
Yeah. So I deal with a lot of clients that have businesses, right?
Mm-hmm.
And they may have a business and reporting taxes with ITIN, right? And that's fine. Okay. So a business owner thinks differently than a wage earner, right? They're more thinking about cash flow, productivity, right? What is flowing through their business, what's going out of their business. They're more tracking those numbers and making sure that they're going to turn a positive income at the end of the day, or in a quarter, or, a year or whatever, right?
Right.
So there's business loans, right? Catered just to business, right? Most of those require 10% down, right?
Right.
They're sometimes based not on taxes if the individual doesn't file enough income tax. We look at the net income, whatever is paid to the IRS after they deduct their expenses,
Right.
their deductions and stuff like that. So whatever's left over is the net income, right? So if the net income is not sufficient to qualify for a house,
Right.
they can do it with bank statements, right? So a business owner that's ITIN can buy a home with business bank statements, right? You take a calculation of those deposits, right? You focus on deposits. They will still need a minimum 25% down, right? And so even though the rate for a business owner, let's say, is 2% or 3% higher,
Right.
but if the payment is within reach and their cash flow in their business is producing enough to basically pay for that, then it's a good move for them, right? Because the other way, the traditional way of reporting sufficient income, right? We know that most business owners do not report all the income.
Yes, we do.
Yeah. Okay.
Yes, we do.
Well, the ones that I see sometimes they don't. And it's okay. I mean, as long as you're doing everything by the book, all right, you should. I'm not here to basically criticize anybody or tell them what to do. But
Sounds like you are.
no, I'm not. Simply that what I want to explain is this, right? So you have to pay somebody.
Yes.
You have to pay either the government your whole tax, right?
Yes.
And report what you should be reporting, paying what you should be paying, right? Most people don't do that. I would probably say in the business world, maybe 70-80% of people don't.
I do.
Yeah. Rico does. Rico does. So if I'm not paying the government their fair share, right? And I'm keeping that money, right? For me, right? Or as a reserve or whatever, right? Then the business bank statement loan, the ITIN loan, is asking you for a bigger down than what a government-backed loan will be asking you, right? Because you got to pay somebody. Either you're paying the government to qualify for their programs, right? Or you're bringing that money down for down payment to basically qualify for those alternative loans,
Okay.
right? So which one do you want to do, right? And so the cost and rate and in payment, if you go with a back government loan, right, is where you can basically come in with 3.5%, 5%, 20% or whatever, right, and get the Federal Reserve to give you their go-in rate, right, or pay the business bank statement loan.
So it's really, there's no right answer to that situation. It's only going to make sense at the time of. So, like right now, things could be perfect under these circumstances. These same circumstances may not be the same 2 years from now.
Yeah, and that's very true, because economies come and go, and cycles come and go.
So let me ask you something. Family of 4, they qualified because they all $173,000.
Going back to the down payment.
Yes, going back to down payment. Are those 4 people responsible for that down payment to pay it back? The reason why I ask is, can one of those quit claim themselves out of the title and still be responsible for the down payment payback, or only the people? Because a lot of families, right? In our culture, like, okay, I'm going to help you qualify, but as soon as I can, just quit claim me out of the deed.
Sure.
So I could, do my own thing.
Yeah.
What are the ramifications on that?
Yeah, so let's say 4 of us go together. We want to buy a house. We want to be on title. We want to have a piece of the action, right?
Right.
Or maybe just 2 of us are basically having a piece of the action. The other ones are just basically qualifying with income, right? So for any down payment assistance program, sometimes when you come off of title, the lender can call the loan due, meaning that if those 4 individuals in that scenario didn't stay on title and granted themselves out, right? Then the lender can say, hey, well, you know what? The agreement that we made, that you guys were all going to be in the title, right? So since one came off, that triggers basically a loan to be called and come due, right?
So a year later, the lender gets notified.
The lender can get notified if somebody gets quick claim or quick claim off title, right?
And when that happens, what does the lender do?
The lender may say, hey, well, you owe me that money now, because one of the stipulations was basically if you refinance, sold a home, or you changed title, or you added somebody to the title, then we want our money back, right? It may or may not happen, right? Depending on how aggressive they are and how fast they want their money.
So it's a case by case.
It's case by case, So
how often does that happen in your experience?
I haven't seen it happen, but it doesn't mean that it doesn't happen, because...
Well, you haven't been notified.
Right. Because if I were notified, like, hey, the lender's calling me to, pay their money back, then I would say, well, we need to refinance, or we need to do something with that loan, because if you did something to trigger a payback, that means that basically the lender is asking you for money back.
So who wants that money back? The lender that underwrote?
The down payment assistance, like CalHFA, California Housing Finance Authority.
So it doesn't matter how many times it was underwritten?
No. So think about it this way, right? So if we buy, let's say 4 of us went and bought a home together, right? And we used down payment assistance because we qualified, or we needed all the income from all individuals to qualify, right? Like, let's say you took somebody off title, right? And the loan wasn't triggered, the down payment program didn't come back and say, hey, you owe me this money, you got to pay me now because you changed your title, right? Whomever stays on title has ownership of the home, right? So if mom and dad and son and daughter basically bought a home together, but the daughter and son took themselves off, right? And mom and dad stayed on stayed on the property, right? Then the parents are the rightful owners of the house.
Right.
Whomever has title is the rightful owner, basically. So
they're responsible for...
Yes, they're responsible for the paying back.
The person that left.
The person that left is like, he had no interest in the house, basically, right? He just says, hey, I forfeit my interest in the home, and I don't want anything to do with it, right? Being on title means ownership. You can decide. Like, I tell people, like, if you add somebody to title, you're giving them right to your home.
Right.
And some people don't understand that. And that's why it's important for them to educate themselves on what that means. What is the proper way to hold title, right? Because
what is a proper way?
It depends.
There's joint tenants. There's
It depends on the family nucleus, right? Like, husband and wife typically will hold title as
nucleus.
Yeah.
What's that?
like the makeup. Like if it's a family or if it's I'm buying a house with my tío. Well, hey, tío, we're going to buy a house together. We're going to go 50-50, right?
Right.
And let's say I'm a married person, right? And my tío is not, right? But he wants 50% of the share. So we can take title as tenants in common, right? I take title as a married man, right? Sole and separate property, right? So something happened to me, the title goes to my wife if I'm married, right? And my tío takes 50% ownership as a single man.
Why wouldn't he take joint tenancy?
Because joint tenancy is for those individuals that are married.
Married.
Yes. So if you're married, something happens to you, joint tenancy means that the title automatically goes to the surviving spouse.
Surviving spouse.
Correct, right? If something happens to both of them, they don't have a living trust, guess who gets to decide?
The state.
Probate. Correct. Yeah.
Speaking of probate, explain to us the difference between the three topics of problems that happens in title. There's short sale, probate, and foreclosure. So let's talk about probate. Does probate, if it goes through probate, does the equity lose like short sale, foreclosure? Because what's the difference between probate?
Yeah, so probate is simply, like if a home goes to probate, because I've been on the loan side on probates. And when a court decides who gets to keep the home, let's say that those individuals that passed away didn't have a will or a living trust, and you have living heirs, right? Like there's the sons, right? And the sons need to go to court and say, Mr. Judge, we're the living heirs of mom and dad, and we want to take the property and be able to sell it, right?
Right.
And so that's what probate is, right? And probate, like I put it like this to my clients, right? Because I've been doing this a long time. It's like, look, we insure our phones, we insure our cars, we insure our health, we insure pretty much anything, right?
Except our house.
Except for the house needs to be insured, right?
But not homeowners insurance. That's separate.
A home is covered by homeowners insurance, right?
Yes.
So if we insure everything under the sun, right? Even our phones, like $1,000 or $1,500.
Yes.
For $35 or $40 a month or $25, they're insured, right? And we work hard to build, right? Real estate. And you don't have a living trust, right? You kind of didn't do it right? Because we pay insurance for everything else, right? And so sometimes not setting up a life insurance, right, to protect your life, right, in case something happens. Because if you're the main income earner and you pass, like you're leaving your family with no income, right?
Right.
And so think about a living trust as saying, hey, I protected everything that was able to build in this lifespan, right?
Right.
And so with that living trust, all my assets are given direction to. So if something were to happen to me, like I can transition peacefully. Like that's going to my wife, tax free, right?
Okay.
Right? And that's going that classic car or that.
It goes to the next of kin.
Yeah.
Mm-hmm. And in a marriage situation, it's the next of kin.
Mm-hmm.
Have you ever had a situation where the next of kin is the wife or the husband, it's a spouse, but the trust says otherwise? Like, yeah, she's my wife, but I want my son or daughter from my first marriage because I didn't have any kids with this person.
Yeah.
She had her own kids. We just didn't decide to have any kids.
Yeah.
I have this. Yeah, according to the law, she's the next of kin, but my trust says I want my kids because I have my grandkids and I want them to have that.
You know, that's it.
What happens in that situation?
I don't know. I wouldn't know that what happens, and
That's
tell you.
an attorney question?
Yes, that's a legal question because we just deal with who can finance, right?
Got it.
We just deal with, okay, you're eligible for financing. This is what we can do, right? The trust makeup, assembly, and setup is up to the attorney, up to the paralegal, up to the family, right? That's what is given right to for.
So whatever is written is what the probate court decides.
Whatever is written in the living trust,
Yes.
right? The trustee, appointee to decide for what was written.
Okay.
So trust deed, right?
Yes.
So I create one. My trustee can be my brother.
Right.
Hey, brother, something happens to me. My properties go to this person.
Yes.
My cryptocurrency goes to this person. My car goes to this person, right?
Got it.
So he just basically takes the leadership to take those assets basically out of the trust.
Got it.
That's all.
Okay.
And then the beneficiaries take on that, right? And so the protection with living trust is just giving your basically your assets direction, right?
Yes.
Protecting you against basically lawsuits,
Got it.
right?
Mm-hmm.
Because it's a legal document, it's recorded. You're passing the title from your individual self to a basically living trust, right? So that's how that works. Since we are more focused on just doing the loan for the individual, regardless of how they acquire the home, we just basically have to meet the requirements of title seasoning, of qualifications for the financing, and that's what we focus on. If a home is in a living trust, we just basically, for loan purposes, it gets taken out of the living trust, right? Put into the individual's name because the individual is financing the loan rather than the living trust. And then the individual can basically move that title back into the living trust.
Can somebody stop a probate if they are not agreeable to the terms? Like, if the trust says my house goes to my kids, not my spouse, can the spouse delay it?
That's a good question. That's
a legal question?
That's a legal question because
Okay.
I think if a wife was...
That's for a different episode.
yeah,
I need to get myself an attorney in here.
yeah.
Okay.
Just think of the living trust for real estate purposes as an added protection, right? Just like in my explanation about insuring everything, but if you don't protect the biggest asset you're gonna have, then you're leaving yourself unprotected. You're leaving yourself opened for lawsuits. You're leaving yourself open for probate. Somebody can take your property, and instead of paying tax on the original purchase price, they're going to pay tax on the actual, right? Current. And to me, that will hurt, right? Because
that's a lot.
That's a lot, right? That means that I fudged up along the way.
You're pretty much inheriting the property.
Yeah.
And you have to sell it.
Yeah. And think about without a living trust, right? Living trust protects the basis of the original. Somebody bought a home today, let's say at 500,
right?
And 20 years from now, the home is worth 750,
right?
Right? Or $900,000, right? Instead of paying on $500,000, they're gonna be paying on $900,000 for taxes, right? So I would rather pay on $500,000 than $900,000, right?
Makes more sense.
Yeah. Or if the house is paid off, then you may not have to, pay anything. So just think about living trust as added protection, right? That in the event that you don't have a will, people, when somebody passes, oh, he said this, or he promised me this.
It's in the trust.
If it's not in the trust, let's go fight for it, So.
Okay. So that's that. I mean, we could go on and on. So foreclosure, short sale.
Mm-hmm.
What's the difference?
Yeah, so foreclosure just means that, hey, you stopped paying, you couldn't pay, you maybe fell on hard times, and you stopped paying. Bank wants their property back. The collateral is, the home, right?
Right.
So you took out a loan, and the trustee that says that if you stop paying, can't pay, they have the right to take their property back.
Right.
Right. A short sale just simply means that, hey, I'm upside down. I owe more than what the property is valued at.
How does that happen?
In markets, we just came out of a market 10 years ago where a lot of people were upside down.
Because they say real estate is the best investment. Real estate, you buy real estate. I think somebody said, Warren Buffett, I could be wrong, I don't know. Mm-hmm. He said, buy real estate because they're not making it anymore.
Sure.
But I just never understood how somebody could be so much upside down on something that a multi-billionaire says your best investment is
Right.
real estate. And we tend to follow people's like Warren Buffett,
Mm-hmm.
you know, and then we have a lot of other people that are just like California, you know, they, like you said earlier,
Yeah.
they want to make us a nation of renters.
Mm-hmm.
So you have mega companies investing and buying out houses and renting them out.
Yeah.
So there's a lot of truth to that.
Yeah.
My only question is, how can somebody, maybe because I've never been in that situation, I've been in upside down situations with
Mhm.
cars,
Oh yeah.
but with property, I've never understood so much upside down. Now,
Sure.
I do understand that there's a lot of houses that don't make any sense being in the neighborhood that they're in.
Yeah.
I could drive down, especially in Downey and Paramount and all those little cities. You're driving down the street and you have all these little houses,
Mm-hmm.
and then you come across this mega 5,000 square foot house,
The Mac mansions.
the Mac Mansion, surrounded by.
Tiny little homes.
It's okay. I understand that could be upside down. I don't know. I think there's a term for that people say.
Yeah.
You know, that's
So think about the upside down as in when the properties came down in value, when we had
yeah,
the biggest, recession, right, that we faced in 2008, 2009, right? So property values declined 40, 50%, right? It was like real estate was on sale, right? And so people that bought homes, let's say from 2005 to 2007, those homes, they were probably purchased at the peak, right? And then that peak went down and lost 30%, maybe it was losing 20%, 30% a year, and at a point, in 2009, you were down like 50%,
yeah,
and not until like 2012, things started, rebounding, and really FHA came in to save the day. Like there were more FHA loans or government-backed loans at that time, right? So if your payment was still affordable in 2008, 2009, there was a lot of government-backed incentives with loan modifications. Banks didn't want to foreclose. If you kept your home, if you upkept the yard and it looked like somebody was living there and the house wasn't trashed,
right.
the bank wasn't wanting to foreclose because somebody was still living in there. There wasn't a squatter or it was
Right.
painful for them because they knew that, this was an unperforming asset for them.
Right.
But they weren't in a rush to get that property because they'd rather have the homeowner take care of the house, pay the utilities and reside there,
Right. They don't,
then take it back. They don't want to take it back. They're not in the business of taking property back.
they make money on the payment, on the interest.
Yeah, exactly. That's what they do, right? So upside down means that you basically owe more than what the property is worth. And most people's idea was that, okay, well, I owe more. I'm still paying a payment, but I'm not going to get anything, right? But people buy houses with different needs, right?
Right.
An investor can buy a home because it's making a certain amount of cash flow. A homeowner is buying a home because they're tired of renting.
Right.
They want to have their own yard. They want to have a dog, right? In an apartment, you can't have a dog.
Right.
But you buy homes because in the long run, could be 5 years, could be 3 years, could be 10 years, right?
Right.
They're going to go up simply because inflation goes up, right? So if your rent is going up, and you can ask anybody that's been renting, rent's gone up like a lot, like 25% in the last, 3 years,
Right.
So one hedge against that inflation or that rent increase is a fixed payment. Because if I buy something today and I have inflation and prices are going up and payments are going up and everything's going up, but I have a fixed payment from 3 years ago, right? That payment is there. It's not going to change, right? But everything else is changing, but not that payment. That's why it's a good hedge against inflation. Because as prices increase and as payments increase, my payment stays the same for 30 years, right? So the idea of buying a home is that within time, that thing should appreciate, right?
Right.
Well, I've been in a cycle in which from 2000. No, wait, from 2007 to 2012, or 2011, they weren't appreciating, right?
Right.
And most people that stayed in their home or were able to dig themselves out of that mess and maybe modify it or
Yes.
fight to keep their homes.
Yeah.
Those are the homeowners that have a lot of equity now, right? That they were able to ride the storm of of financial hardship and really a big mess, right, in the economy, right?
Right.
And those are the homeowners that have a lot of equity now, right? Because maybe they owed $400 or $500 or maybe $600,000, right? And now those homes are probably worth $800,000, $900,000, right? I know a lot of clients like that, right? And so if they were able to modify for some, if they were able to keep the home, basically they did good, right? And so now those are the homeowners that are benefiting because they were able to withstand, right? No matter how they did it, right? Through modifications or government-backed assistance or working 2 or 3 year jobs or whatever the case might be, or renting out the house or, renting rooms or whatever the case, but they made it through, right? Because home appreciation or equity is one of those things that is here today, could be gone tomorrow, right? It's like it's built through economic uproar, good times, right? Prices go up, right? And that difference between what you owe and what it's worth, it's equity.
So, as a mortgage planner, can a person refinance a house in the middle of foreclosure, or it's upside down? Or does that even happen? Is it possible?
Possibly not.
No.
Probably not, because if you're going through foreclosure, you probably stop paying your mortgage. You probably don't have income. You probably are not working. You probably couldn't pay.
Well, sometimes you do have the income, but let's just say you're going through a divorce, or a probate, and the house is on foreclosure by choice, not by circumstance.
Yeah. So if it's in foreclosure because you're going through those kinds of situations, it's best for you if you have equity in the house, right? Like somebody's going through a divorce and, they can't come together on salvaging their home, right? Or whatever is left of their home, right? Then they really have to get a different attorney or come to terms with themselves. I'll come to Jesus talk, right?
Yes.
It's like, if I have $300,000, I have equity in the house, and you get 150 and I get 150 and we get to walk away from this relationship, right?
Let's do it.
Let's do it, right? You start fresh, I start fresh, and with that 150, you do whatever you want, and I do whatever I want, right? Because it shouldn't be, I think that, when a relationship ends, it shouldn't be about what you don't or you don't get. It should be more about
what
benefits us or what benefits the kids. Most dads decide that the wife and the kids should keep the house, right? I just want a little bit so that I'm not in the streets, right? But that's not up to me. That's up to the attorneys and each individual, right?
Okay.
But whatever is fair is fair. I think that it shouldn't be about what I created. It should be about what can we walk out of this with our head up high, and still feel like we can be friends.
Right.
Like if I saw you on the streets,
okay,
I'm not going to bad mouth you or be like, you're this and that, right?
So, as a mortgage planner, is there a time limit where the person, I'm hoping I'm asking the question
okay.
correctly. Is there a time frame, or what's more easier to work with 2 or 3 years later, a person that went through foreclosure or a person that experienced an upside down situation, short sale?
Yeah.
What's more favorable to that person?
Right. So here's the beauty of going through a hardship like that, or going through restructuring, right? Foreclosure, short sale, bankruptcy, or something like that, right? Loan programs, they have a waiting period on some life event, right? So, like for instance, a foreclosure, you got to wait 4 years for a conventional loan. I'm sorry.
What about FHA?
No, for foreclosures is 7 years for a conventional loan. For FHA is 3 years. For a short sale is 4 years for a conventional, and 2 years basically for an FHA loan.
Okay, so let's recap. So a person goes through a foreclosure.
Yes.
If he wants to qualify for an FHA, how much long does he have to wait?
3 years.
3 years. And conventional?
7 years.
7 years.
Yes.
Okay, so going back to the down payment assistance,
Yes.
he foreclosed on the house.
Yes.
He waited 3 years.
3 years.
He's a first-time buyer.
Yes.
Because of that foreclosure,
Yes.
is he eligible for the down payment assistance?
Yes.
Really?
Yes. Yeah. Remember that, we
A
all,
lot of people don't know that.
well, they may or may not know that.
I don't think they do.
But think about,
A lot of people will be doing a lot of that.
well, most people's heads are in the sand when they go through a financial hardship.
That's why we have this at the Rico's report, because we're talking about it.
Right. Because think about going through a short sale foreclosure bankruptcy is like death to the situation.
Yes.
Right. It's like a death in your situation, in your life. Right.
Right.
But there's also a rebirth,
Yes.
because a bankruptcy it's sort of like it cured everything. It wiped out
We
everything.
didn't mention bankruptcy, which that was going to be my next question.
Gotcha.
Okay.
And foreclosure mean that, shoot, I fell behind. Maybe I got a disability, or I went through, financial hardship, right? I couldn't pay, right? But think about it. Right now, most people have 40-50% equity
Right.
in their homes, even more.
Right.
So if I have that kind of equity and I'm going to go foreclose, right? I don't want to lose my equity.
No, of course not.
So an agent is going to call, probably an investor is going to call, and they're going to offer you something. Either sell it at market, sell it for a discount, or basically sell it to an investor, right?
Right.
But you're not going to lose, right?
No.
If it was 2008, 2009, yeah, you're probably going to walk away, right? Like, I don't want this piece of shit. Like, this is upside down,
Yeah.
right? It's not serving me, right? And there were a lot of people like that, right? So nowadays it's different because everybody's equity rich.
So that's a foreclosure. So 3 years for an FHA, 7 years for a conventional.
Mm-hmm.
Okay. No ifs, ands, or buts for conventional. You have to wait 7 years.
You have to wait 7 years. Now,
Okay.
with foreclosures, yes, you have to wait that from the time of recording. So if I foreclose on a home, but the bank took it back and didn't sell it until a year from now, it's actually from the bank disposed of the property, right? And so think about
that could be longer than 3 to
it. Could, but most banks right now, they take that property, they rehab it, clean it up, and sell it to a market, right?
boom.
So things are moving much faster these days, right?
Yeah.
No longer are you going to be in your home fucking 7 years or 3 years or waiting for the bank to knock and say, hey, that's my property still. Like, we want you out now, right? Now it's like, no, let's move you out. We can make so much more taking this property back than keeping you in there.
So short sale.
Yes.
How long do you have to wait after a short sale to qualify for a FHA?
2 years.
2 years for FHA?
Yep.
Unconventional?
4 years.
So when it comes to that time frame to buy another property, unless you have cash, obviously, you're better off with a short sale.
Yeah, you're better off with a short sale, because a short sale simply means that, hey, Mr. Bank, my house is upside down. I can't afford it. I need to sell it. Would you cooperate with me to basically sell it upside down? And will you let me sell it and not incur the loss?
So we know what a foreclosure is, right?
Yeah.
The person didn't want to pay it, so they just told the bank to go shove it, and I'm done. But a short sale, when does a short sale become a foreclosure? When they stop paying the mortgage? So let's just say hypothetically, a person is upside down,
Yeah.
but they stop paying for this payment. Does that situation become a foreclosure or a short sale?
A foreclosure becomes a situation when somebody hasn't paid for 3 months and the bank files a notice of default saying that, hey, you haven't paid. Since you haven't paid,
Even though the house is upside down?
even though the house is upside down, it doesn't matter, because the bank has every right to take that property back,
Okay.
right? So think about a foreclosure is like, okay, well, something's happened financially. You haven't been able to pay. Why haven't you reached out to us, right? most people should reach out to their bank or their servicer,
Right.
because they should. If you haven't paid for 1 or 2 months, there's something obviously going on there.
Right.
It's a financial crisis, hardship going on. Right?
Document.
Exactly. If you came to me, like, I'm a landlord, right? If my tenant came to me and said, Aris, I can't pay you on the 1st because so and so my daughter got sick and I had to spend all this, money to the hospital and medication and stuff like that. So I'm a little short, but I'm going to be able to pay you by the 10th, right? Here's half down, right? What I owe you.
Right.
Or the next half is that, right?
Right.
If I'm approached that way, right, I may work with that individual.
Of course.
Right, because
That makes sense.
right, because at the end of the day, I don't want my tenant out. If he had a family emergency or something happened, and he's been there a long time, he doesn't do this every month.
Right.
I'm gonna make sure that I work with him and that that I give him some grace.
Right.
Right.
Yeah.
If I can. Right.
Makes sense.
Yeah, because at the end of the day, we're all humans. These things happen, right? So, if you're dealing with financial hardship, the best thing you do is reach out to the bank and say, listen, I'm having a hard time financially. I can't pay it. Is there an option for me? What programs are available, through the government or through you, right?
Okay.
On forbearance, on modification, right? And then the bank will tell you what the investor, right, has available for you. If the investor can basically postpone payments for a certain period of time, like they did in, the pandemic, right? Or maybe they do a modification where they can lower the payment for a specific amount of time, right? You just have to raise your hand
Yeah.
and ask.
I
Right.
need help.
Yeah, and if they say, sorry, but the investor that we have the investor for the money is not willing to help, or there's no government-backed programs for you, right? Then you have to maybe just sell the home, right? The last thing you want to do is just go to foreclosure.
Right.
Because you should be able to sell it. You should be able to basically, try to get as much as you can for it, right? So foreclosure is like one of those last things that you should do.
As a mortgage planner, what do mortgage planners, advisors prefer to see, a foreclosure or a short sale?
Well,
I mean, neither, obviously.
yeah.
But what is more favorable to make the file?
Well, we really don't like to see any of them, right? But what we do like to see is that people rebuild themselves after that, right? Your head shouldn't be in the sand. Like if you were foreclosed or short sold, or you had to file bankruptcy, right, to eliminate your debt, what you should be doing is learn your lesson.
Right.
Learn your financial lesson, right? And then create a different story, right? Have a different rebirth for yourself, right? Recreate yourself, and you recreate yourself with better financial habits,
Right.
rebuilding your credit, right? Bankruptcy, short sale, foreclosure are not the end of it all.
Right.
We are given the opportunity here in the U.S. to recreate ourselves, reinvent ourselves.
Right.
Now, if you want the fucking same story to happen, where you get that handed to you again in a decade or 5 years, then you don't change your habits. But
Right.
I think that, if you learn your lesson,
Right.
you should be doing things differently,
Right.
right?
Right.
And so that's what that is. It's just a death and a rebirth, a financial rebirth,
Got it.
right?
One last question. When we first started this
Yeah.
first video, episode 101,
Yeah.
I told my kids, you guys are gonna be the first ones, but but this is what happens. I mean, you became the first one. But when I first asked you, who are you and who are you with?
Yeah.
You mentioned that you are with the Mortgage
Phoenix Group. Yeah.
but you said something that you are a direct lender.
Yes.
Could you tell us what does that? I know what it is.
Yeah. Yeah. Yeah.
But what is the difference between a direct lender and a mortgage broker?
Sure. So a direct lender is basically a bank, a mortgage bank that underwrites their own loans,
Right.
finances their own loans, basically, and has a centralized location to do this, right?
Got it.
So you can come to my office, I have a processing team, right? American Pacific Mortgage is based out of Roseville, Northern California. They handle all the underwriting there, all the funding there, right? And we handle the front end, our office, right? So you're coming to a specialty bank that just deals just in mortgages.
Got it.
Where you go to a bank, they deal with mortgages, investments, savings, checkings, business, insurances, and stuff like that. So they're not just dealing with mortgages. A mortgage broker deals with different banks that may have the same product for you, and is trying to find you the best product for your situation.
Got it.
By going to different banks, different outlets, right? We have that option as well through our wholesale channels of lenders.
So that's the benefit of being a direct lender.
Yeah, because we can fund our own loans at the same time we can look for the best source for your situation, right? If it doesn't meet the box of loans that we have, right? So
okay,
it's sort of like the best of both worlds, right? It's like because you're given quality service, you're given dedicated a team to take care of you. And at the same time, if you have a special need like business bank statement loans or banks, investor loans, or maybe you want to do like a short-term rental or something like that, there may be loans for that.
Are those what they're called, the hard money loans?
Private money loans.
Private or hard money?
Hard money. Hard money is a hard term, right? So hard money is for somebody that, maybe has good credit, but they don't document any income. They just want it to be based on the equity of the home. And
that'll be me.
That could be you. Like, I just want to take a loan that, doesn't check my background, doesn't check my income, or doesn't.
The numbers match up.
Yeah, but it's more like I have a lot of equity in my house, so they'll be willing to loan you maybe 60% loan to value. They'll be able to give you a loan for a year rather than 30 years, right? And the terms may be where you have a prepayment penalty for a specific amount of time. So if you pay off the loan, less than what the time allowed, they'll penalize you. The rates are, 10, 12%, harder terms, or, then what?
Well, hence the term hard money, right?
Hard money, right? So hard terms, right? Maybe not the best loans for everybody, right? But under the circumstances, if that's the only loan you can get, and it's a short fix to get you cleaned up, get you going,
do it.
You got to do it, right? Because
gotta pay the price.
Yeah, everybody pays the price based on their qualifications.
Yeah. How can I get a hold of you?
You can find me at on the social medias. At on Facebook. I'm on Facebook. I'm on on Instagram and stuff like that. But that's probably the best source.
What's your phone number?
Yeah, it's really simple. 626-488-3640.
And you speak Spanish, or
Claro que sí. Bilingual, yeah.
Well, thank you so much for being the first one of my episode. This is fun.
Yeah, it's been fun.
I hope our editor puts everything together nicely.
Yes.
This episode is sponsored by Vortex Inspection Group and Cyclone Plumbing.
Yes.
And again, thank you for being here.
Yeah. Before you go, you close it out, I just want to say thank you. Rigo has been a great friend to me. I think this session happened simply because we always like to mastermind, talk, visioneer, strategize, and even though your kids are going to be probably your first,
No, you're right.
and it's fine. But I think that when the information could be a benefit to others and help them in their journey of investing in homeownership, and it's well worth it. And I just wanted to say to Vortex and today's home inspection that you've been my home inspector on the properties that I purchased. And the reason why I've chose you is because I know that I can count on your expertise. I can count on you saying, this is a good deal, Aris, or it's a good deal, but it needs this, right? So you kind of protect my blind side, and you give me sound advice on what to expect, what I'm buying, what should I anticipate. And even though I can look at it from an investor's point of view, but I never have the eye of the inspector.
Yeah.
Right. And that's where you can come in. Yeah.
Well, it's kind of like what we're talking about. What makes more sense when you're financing a home?
Sure.
Do you prefer to see a foreclosure or a short sale?
Mm-hmm.
If I was a lender, I'd rather see a short sale than a foreclosure. Right.
Mm-hmm.
I don't want to see none of them, but at least a short sale, it was caused by circumstance, not by choice. A foreclosure is caused by choice, not by circumstance.
Right.
And so that's what it is. But this is great. I like this.
Yeah.
Well, thank you so much, man, for coming.
Rico, thank you for having me. I didn't know I was going to be your first.
No.